What's up, everybody? Right before we get into the show here, just want to give a quick shout out for our next Blockworks conference coming up in just over a month. Permissionless 4 is happening June 24th to 26th, and it's a crypto conference all for the developers and builders in the space. We're going to be hosting it right in the heart of Brooklyn, New York, and it's going to be a ton of fun. There's going to be a lot of fantastic speakers, and the whole Forward Guidance crew is going to be there. Myself, Tyler, Quinn, we're going to be doing a live roundup. There's going to be some wicked community events. Come meet us, have a beer with us. Come see some of the awesome side events, some fantastic speakers. There's new ones being announced every single day. So go ahead and get your tickets. Use the code FG10 to get 10% off and don't miss out. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, what's going on, everybody? Welcome back to another episode of Forward Guidance. And joining me today is Kevin Muir, author, founder, editor of the MacroTourist. And this is going to be a funny episode because now you're going to have two Canadians talking deeply about the U.S. fiscal situation. But here we are.
Great to be with you today, Felix. Nice to meet you.
Yeah, likewise. This has been wildly overdue. Yeah. So, okay, let's get right into things. I wanted to get you on the show because it feels like we were just saying off camera before we started here that there's been two buckets of people in terms of how they think about their macro frameworks and everything. And there's the traditional bucket, which has been, okay, stuff like the yield curve is inverted, so the recession is imminent. And that bucket has been pretty provably on the wrong side for the last couple of years. But then there's this other bucket of folks like yourself that really focus on the fiscal things. What are the implications of it? How does that dominate the monetary side of things? And they've been a lot more correct. So I wanted to get you on the show and just start off really top level of how do you articulate this macro framework that you have that is so heavily weighted towards the fiscal side of things? And how has that kept you on mostly the right track of things for the last few years?
Actually, let's just rewind and think about the macro environment in the mid to late 2010s. And at that time, if you remember, we came off of the GFC. We had this situation where we had quantitative easing. We had these extraordinary monetary measures. I still remember, Bernanke doing doing the Operation Twist and doing the second round of quantitative easing. And there was that article in the Wall Street Journal that was signed by a slew of really prominent market strategists, economists saying that this was going to be a disaster. And back then I would have signed that gladly as well. Like I thought this is it. This is going to create all this inflation. And this is the kind of, the dollar's going to go down. But then Bernanke went and did this quantitative easing and none of the horror stories that we were led to believe came to be. And I started thinking about things and I was like, okay, well, why is that? And I really took a moment to think about, if you have a theory about why something should occur and it doesn't occur, you should, instead of just continually applying that theory, you should think about why you're wrong. And it came upon one time, people started talking about this MMT. And I was like, what's this MMT? I have no clue. And one of my buddies, George Perks from Bespoke, he was really into it. And he was one of the fellows that would talk about it. And I kind of reached out to him and said, okay, can you put me on like a track to learn about MMT? So he, points me to Shelton and all the other professors. And I go home and I start digging in it and I watch a lecture and I'm sitting there and I'm screaming at the TV. I'm screaming at it. I'm like, no, that's not right. That's wrong. And so I think to myself, well, if it's so wrong, I should go about proving it's wrong. So I go and I start trying to figure out where they got it wrong. And I'm like, I can't do it. And I'm just like, oh, you know what? actually makes sense. And then I keep going through it and I keep doing it. And I gradually start to reach out to other folks that are, more MMT sympathetic. And I start learning about it. And the more I learn about it, the more I realize that in terms of predicting what is actually going to happen in the economy and markets, they're being way more right than any other school of thought. And I just want to take a moment here because a lot of people are going to, just thrown up in their mouth a little bit right there when I said that, because a lot of folks hear MMT and they just, they see the people that think that you should go and spend with abandon and go and do all these crazy social experiments. And that's not really what MMT is. MMT is a way of explaining how the modern economy works in an age of a fiat-based monetary system. And that is the problem, is that a lot of the traditional economic textbooks that we learn from were all based upon a system that was when we were gold-backed. What happened was we went and changed the system from gold-backed to this fiat system, and we didn't change any of our rules. And the economy works a lot differently. So gradually, I would just start to be more and more kind of knowledgeable about MMT. And I realized it was doing a much better job at explaining what was happening in the markets, what was happening in the economy. And it was just one of these kind of light bulbs that went off when I realized that everyone's focused on the private sector credit creation side of the economy, when the reality was that because we were balance sheet constrained, because we had gone down to zero, that sector was no longer working. And that really what mattered was the fiscal side, meaning that there's two ways monies can be created. One is it can be borrowed into existence. You go take a loan, buy a house. The other is for the government to spend it into existence. And since then, it's just kind of been all great in terms of helping me understand and make some great calls. Like, for example, in the COVID crisis, a lot of folks said there was no way that we were going to be able to fix this problem. It's easy to forget now, but if you go back and look at like March of 2020, there was all sorts of doom calls out there. And I said, if there's enough political will and the government spends enough, and they can actually, fix the economy and kind of fill the hole that is being created by COVID. So ultimately, I just came to the conclusion that this idea that governments are constrained by, the traditional Ken Rogoff, Carmen Reinhardt beliefs about amount of debt was just incorrect. And that really what governments are constrained about is inflation.
So let's paint some constraints around here, and I'll do so by just throwing a few propositions at you, and you can tell me on what spectrum do you sit within them. So, the proposition of higher interest rates being stimulative because, if you have a higher Fed funds rate, somebody that owns a T-bill is going to be getting 5% coupons on that. Where do you sit in terms of that regard of is that actually outright stimulative, or is it just the way I see it is the spectrum between the inflows of interest payments that they get from the government versus their obligations. But then again, if their obligations are 30-year fixed mortgage rates or something like that, that's fixed. Yeah. How do you think about that spectrum?
So, I've seen your great interviews with Warren Mosler, and he's definitely the godfather of this. And far be it from me to say that he's ever incorrect, but I lay a little bit more in there's elements of truth to both systems. And where I push back on a lot of MMT folks is that they seem to focus solely on the credit creation side of money being spent into existence. And they almost forget about the private credit side. They almost say, oh, no, that doesn't matter as much. And just kind of to back up a little bit, if we think about 1982 all the way to 2010, actually even to 2020, we had this period where every single time that we got into trouble with the economy, we tried to fix it with monetary means. So we got into a recession, they lower rates. What the lowering rates does is tries to encourage people to borrow more. Corporations borrow more, people borrow more. You create economic activity. The economy loops back up. Then all of a sudden, economy slows down again because rates are gone back up. Goes down. This time you need to lower rates to even a lower level because there's even more debt in the system. So you lower it even lower. So each time, if you look from 1982 all the way to 2020, every single decline in the Fed funds hit a new low, and every single subsequent raising hit a new low, meaning it's a series of subsequently lower and lower highs. Okay. And then eventually what happened was in 2008, we got into the situation where the private sector just refused to borrow anymore. And so we tried all these crazy, methods, and we said, no, monetary system doesn't work, or monetary stimulus doesn't work when your balance sheet constrained. And then we kind of finally in 2020 realized that there's this other thing called fiscal. Now, the real problem about it is that we did way too much fiscal. Like we did just way, way too much, especially in America. And this is one of, my first complaints about MMT is that they always said the government is not financially constrained, but it is constrained by inflation. And so therefore, if you're spending too much or taxing too little at a point when you actually get inflation in the system. Well, guess what? We got inflation. And yet everyone in the MMT world said, no, that inflation doesn't count. Well, I call BS on that. The reality is that the way that MMT works is if you have inflation, it means that you're spending too much and therefore you should pull back. Now, your question was in terms of that idea about raising rates and whether that is stimulative or not, because Warren Mosler would argue it is stimulative. And I know that kind of seems crazy. People will go, wait, that doesn't make any sense. Why would raising rates be stimulative? Well, I would say that especially in this last time, in terms of this last cycle, this post-COVID raising of rates, it was stimulative. And I would agree with him that it was a situation where the government raised rates that actually caused the economy to speed up, not slow down. Let me tell you why. We had a situation where in COVID, there was this monster amount of QE. Everyone went out and borrowed as long as they could in terms of mortgages. If you were a homeowner, you went and extended and bought 30-year at 2% or whatever. If you were a corporation, you refinanced because the government was doing QE. It wasn't just doing QE on governments, it was actually doing QE on corporations. So we had this situation where all of the usual folks that were kind of sensitive to rate hikes had locked in their rate hikes. I mean, had locked in their duration. They were no longer exposed to rates. So when the Fed started raising rates, usually what happens is that curtails home building. It curtails corporations. But all these companies had already borrowed everything they had. And not only that, everyone had all this money. So they had this situation where the Fed's raising rates didn't have the traditional effect on the private sector economy that it usually does. It was muted, okay? And then on top of that, we had a situation where the government had the most borrowing in history, or modern history, and therefore, as they raised rates, they ended up having to pay more on that debt, which increased the fiscal deficit. And one of the things that I truly believe in that I think a lot of people have trouble with, but if you take a moment and just stop and think about it, I think it makes a lot of sense, is that the government's deficit is the private sector's credit. So when the government was going out and increasing the rate that they were paying on their debt, they were putting money into the private sector. So we actually had a situation where on the government side, the deficits were increasing because of higher rates. And then on the private sector side, the private sector wasn't that sensitive to rates. So I think in this last cycle, it very much had a situation where the higher the Fed raised rates, the faster the economy went.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Interesting. So we'll get into a minute in terms of where we're at in the current fiscal path and where it goes from here. But the second proposition I want to throw at you is we're recording this right off the weekend of the Moody's downgrade of U.S. debt. And that's a really interesting irony for me when I contrast it with what we just talked about. So it's like, okay, you're telling me that we downgraded the U.S. debt because they're running too high of fiscal deficits, which means too much stimulus to the private sector. So I'm going to go ahead and, you see some takes of it is, okay, credit downgrade, that sounds bearish for U.S. equities or something. So I'm going to go short U.S. equities. But yeah, how do you think about just the framework that is used in this modern era of rating agencies saying that, they're spending too much money, so that's a risk? How do you think about all of that?
So in terms of credit rating for governments, it's irrelevant. The reality is that the U.S. Will never default. And if they default, it'll be a technical default and a choice. But the reality is that they can always print more money to pay off any sort of debt. So it's kind of foolish to even be worried about it. And not only that, there was a time when the institutional clients did have restrictions about the type of debt that they could own. So when you had a situation where it no longer became AAA, there was forced sellers of that. That's gone. So it's almost meaningless. The only thing that you might take away from the ratings downgrade is just highlighting the fact that the U.S. is running such a crazy, crazy deficit. And I don't think people truly appreciate the level of deficits that's going on. I know when I talk to folks and I ask them, what do you think the deficit is in the U.S. versus Europe or versus Canada, right? We think about those socialist countries, those things that not only that, they're crazy. They're spending all this money. The U.S. is running, or last year ran a 7% deficit to GDP. Okay. Canada was 2 or 2.5. Europe was 2.5 or 3. Japan was 2.5 or 3. The U.S. was just kind of miles ahead of everyone else in terms of their deficits. And not only that, when we look at the amount of spending that's done in the post-COVID environment, the next closest economy is like half of what the U.S. did in terms of the stimulus. So when going back to your kind of question about using fiscal to explain, market movements, to me, it's been very clear why the U.S. has been such a strong economy. It's because they've been running the largest deficits.
Yeah, and it seems like obviously we've established that this framework, the constraining factor is inflation, and MMPers are incorrect in saying that, oh no, the 2021, 2022 inflation was a non-issue, wasn't real. But I think, we both agree that is the case. And so that constraining factor, I would argue, led to the election of President Trump on this idea of Doge and reining in fiscal deficits. So let's unpack where we're at today, because it's been a complete 180. So obviously January to mid-March, there was these notions of even Howard Lutnick saying balancing the budget, which is insane to me. And $1 trillion plus Doge cuts.
Yep.
And so that was a narrative.
$2 trillion.
Obviously, $2 trillion even at one point.
Yeah.
And so that was the narrative, is to get rein it in. And obviously the narrative is shifting significantly. So I want to ask you about, how have you thought about those first few months in terms of the fiscal path? And then obviously, how are you thinking about it today with what is clearly a pretty significant pivot?
It was interesting to see what the evolution of the markets over the last 4 or 5 months. And I remember when Trump was elected, I kind of laughed and said, he's going to make macro great again. And because I said, and I wrote it, I said, we're going back to the 1980s world of George Soros, Michael Steinhardt, and all of a sudden, all the big macro things mattering way more than in the past. And he's been, wow, he sure delivered on that. So when we first came into being, when he first came into the kind of taking over power, there was a lot of folks that were excited about the market. And let's just kind of rewind to, let's just say, late 2024, early 2025. And I remember I went to a conference in New York City. And at the time, we had guys like Stanley Druckenmiller saying this was the most business-friendly administration in decades. We had guys like Bill Ackman talking about how this was going to unleash the golden era of America. On the cover of The Economist, there was all these, terrific, rocket ships to the moon for the US. Like American exceptionalism was just everywhere. And I remember I went and I was on this panel, and I suggested that the US dollar could go down, and that even, God forbid, stocks could go down, US stocks. I felt like I was going to get booed off the stage. Like, honestly, it was just brutal. Like it was just silence. And everyone told me I didn't understand it. I didn't get this kind of new Trump environment. And I said, listen, this guy is doing some wild stuff. And not only that, if you listen to what he believes in terms of his desire to get both the trade deficit and the government deficit down, both of those are extremely negative for stock market prices. The fiscal deficit we just talked about. We've explained why if you cut government spending, a lot of times it'll cause the economy to weaken. But in terms of the trade deficit, one of the parts that a lot of people kind of miss is that over the years, kind of there's been this unspoken agreement with the US versus the rest of the world. It's like America will buy your stuff and we'll sell you overpriced financial assets, right? Because if you think about it, if you go, let's just take, for example, the iPhone. The iPhone is built in China. Well, Americans are paying US dollars for them. So when they go buy all these, gajillion amounts of iPhones, usually what would happen is that you would pay for them US dollars. So you would have to buy renminbi or yuan to pay for those. And eventually what would happen is the price of the renminbi would go higher. But the trouble was China didn't want that to occur. So they stood in the middle and said, listen, we'll sell you the renminbi. And what we'll do is we'll leave the funds in US dollars and we'll actually recycle them. And so it's been this environment where on one side is the great amount of goods that the US buys, and on the other side is the amount that is invested in the US. And someone sent me this chart, and it was the change in the trade deficit versus the change in the NASDAQ. And I looked at this thing, and I was just shocked at the correlation. Like if the trade deficit goes up, it gets wider, the NASDAQ would go higher. Trade deficit would shrink, it would go down. And I thought to myself, well, this can't be. When I did the old Ronald Reagan trust but verify. So I went and made it myself, and I was completely blown away. Like the relationship's there, it works. And it kind of made me realize that if Trump is successful in what he says he wants to do, which is eliminate the trade deficit, get it to zero, because don't forget, he thinks that a trade deficit is the US losing. If he is successful in that, it'll actually cause stocks to go down in price. And so, going back to early 2025, I was sitting here and saying all of these policies that he is espousing are bad for stocks. Yet everyone was all excited about it and saying how, this is the most terrific thing, blah, 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 blah. Well, I kept saying, well, listen, this guy loves tariffs. And we have this situation where, he wants to get the trade deficit down. Besant's telling us he wants to get the the government deficit down. This is just all around bad. So what occurs is we have this Liberation Day. The trade deficit ends up being way higher. The tariffs end up being way higher than everyone expects. Stock market sells off. All of a sudden, Besant looks at this and says, there's no way I can actually get the deficit down. And he pivots. They put Navarro on the bench, which is like the goofball that kind of made a mess of the trade. Scott takes over. Wall Street breathes this sigh of relief and says, look, an adult's in charge. And not only that, he seems to abandon this idea about balancing the budget. And to your point, your question was like, how do I reconcile this? It's a problem right now because I listened to Scott and I realized that he has shifted from this idea about getting the 3-3-3. What was it? 3% deficit to GDP, 3% interest rates, and 3 million barrels of oil. That was his kind of big grand plan.
Yeah, and he was talking about the 10-year a lot at that time too.
Yeah, so it was 3% 10-year. Maybe that was it. It was but regardless, like he had this plan, and now all of a sudden he's like, screw it. We're gonna outrun this thing by growing so much, and so they've completely abandoned this. And I mentioned earlier how the U.S. was running a 7% deficit to GDP. Well, that was last year, and I tracked this. I track kind of on a monthly basis the deficit, and I've been shocked. This fiscal year, and the government ends at the end of September. So between October, November, January, February, March, the deficit has been running like almost 20% higher. So we are running like super, super flat out, like very stimulative. So to me, I kind of have been struggling with this because I was bearish and I was correctly bearish, and I did stay with my bearishness, and I covered it okay into the decline, but I've kind of gotten, on the subsequent rally, I've gotten too bearish again too quickly. And the reason I think is when I'm thinking about like why am I being wrong? And that's always, I think, important to ask yourself, like, so instead of being like, say, no, everyone else is wrong, you should say, like at the end of the day, my pocketbook's hurting. I'm obviously wrong. I got the wrong call. And I go, why have I been wrong? And part of the reason I think I've been wrong is that I've underestimated their willingness to have massive fiscal deficits. Like I have completely and utterly thought that there was no way that we would be in a situation where it seems to be that they're willing to run this crazy, large deficits with no real sign that any adult is trying to pull it back in. And ultimately, that's why I think we've gotten this just vicious rally. It's because we're still running an extremely hot, economy. So everyone else is focused on interest rates and going, the Fed this, the Fed that. The Fed doesn't matter. This is actually much more a fiscal show, and the fiscal dominance means way more.
Okay, I want to throw something at you that I've been thinking about that might help us try to square up this paradox, because I've been confused too that it just is a complete 180 from what they're trying to achieve. So what you characterized there was this dynamic of the current account deficit widening because stuff comes in, and then the capital account surplus increases because dollars go out to the rest of the world. And tariffs have been a mechanism to try to narrow the current account deficit through tariffs. But what I'm starting to wonder about is, what if they try to tackle the capital account surplus side of things instead? So there's been a couple interesting tidbits in this upcoming fiscal bill, which I'm sure we'll talk about. But there's been a couple interesting tidbits in there around taxing remittances out of the U.S. to foreigners, and foreign withholding taxes. And I'm like, okay, well, what if they shift towards capital controls?
Yeah,
to narrow things. Yeah, what do you think of that?
So when I was bearish earlier in the year, and I was explaining to folks the reasoning behind this, the biggest pushback I got was from the folks that would like listen to my argument and go, yes, I completely agree with you that if he gets trade deficits down, or if he gets the fiscal deficits down, that the stock market will go down, but he doesn't really want those. Like I still remember talking to like this really smart hedge fund guy. He says, Kev, listen, I'm with you. I completely agree. Your analysis is correct. If we actually get a trade deficit down to zero, if we get the fiscal deficit down, then the stocks are going to head lower. But he doesn't want that. And then he said, not only that, he doesn't want that. And not only that, it's not even sure if he does the tariffs that it'll actually cause what everyone thinks it'll cause. And we might actually even get more money flowing into the US for much the reasons that you just highlighted. And we kind of, brainstormed and went back and forth. And we said, ultimately, really, the problem is too many people want to invest in America. And that is ultimately kind of, part of the problem. And I know that seems like a kind of weird way to describe that as a problem, but it really does create these imbalances that we're talking about. And I would agree with you that one way to solve this and to kind of fix the trade deficit issue is to start taxing foreign capital into the US. It is 100% would work. It is probably what is needed. But Felix, what's the result of that in terms of stock market performance?
Lower.
Right.
Yeah.
So this is the problem, is that, and this is, I have so much problem with a lot of folks that'll say, they'll argue on one hand, this needs to be done, and that Trump's doing these things for the benefit of the working class. And I'll go, great, whatever. I'm not here to tell a society what choices they should make. I'm only interested in trying to figure out what choices are made and then what the effects are on the stocks and the bonds and the different asset classes. And so for me, I look at it and say, if you go and are successful in getting the trade deficit down, almost by definition, it's going to mean lower stock market prices. And that's the part that I think that people struggle with. And I don't know what Trump is going to do. I don't know if he understands that. I don't know if he's prepared for that, that trade-off. I think at one point it seemed like they almost did, because you remember he started telling everyone, no, we're going to have some pain, stop being, not worrying about stuff. And now he's unfortunately kind of panicked again. And one of my buddies sent me something. He says that there's they're calling him Taco Trump. Trump always chickens out. That's what they say. And I know you'll hear, oh no, he got what he wanted in terms of the negotiations with China. And I just that's not true. He did chicken out, and it doesn't, we can argue about it. And it doesn't really matter, because ultimately price matters in terms of the stocks more than anything else. So I kind of usually avoid those political discussions. But the reality is that we are kind of at this weird paradox with this weird, unease in terms of what he wants and what that means for the stock market and the economy on the other hand. And I don't think people appreciate that enough.
100%. I'm curious how yourself as a trader navigates this environment of probabilistic outcomes, because that's what we're pretty good at as traders, generally speaking. But obviously, this is a very wide distribution where it feels like it's sort of an if-then environment where, if they, narrow the trade deficit, we know U.S. assets lower, U.S. equities lower, bond yields higher probably. But then on the other side of things, if they completely abandon everything else, we end up with high fiscal deficits and probably the return to 2023, 2024. So yeah, as a trader, how do you navigate basically this fork in the road?
So when he was elected, one of the things that I said in that piece where I argued about Trump, making macro great again, I said, we're going to have higher inflation, we're going to have a steeper yield curve, and we're going to have more volatility. And for the longest time, I have been telling people that they should be expressing their views through owning long dated options. And I got to tell you something. I actually, I cut my eye teeth on an institutional equity derivative desk, and I was the equity derivatives trader, and we were always short vol. I spent my whole life short vol. I generally vol trades, implied vol trades higher than realized vol in equity land, especially equity index land. And so we had this situation where it just always made sense. We had a bank's balance sheet, so we were always short. So I've hated to be long volatility. It's just kind of not in me. But
does that include long call options?
Yeah, I would just in general, we would be usually for equity index volatility. that you were better off being short. And that was just always the case. Like it was always overpriced. Even now, like if you go look at most equity traders, equity index traders, they end up having to sell skew. That's how you get paid, meaning that you're short the way out of the monies. They're long at the monies. But on the whole, there's a million ways to do this. But one of the things that I've learned as I've aged and matured a little and no longer just want to be short vol is that I've talked to a lot of really smart folks, and I realized how many guys that had that extra comma in their net worth, like the 2 commas, how many of them used long dated options as a way to express their view. And I was shocked about it. I was like, oh, really? I was like, Jim Leitner, I'm lucky to count him as a friend. And he would just explain to me, oh yeah, I owed 1 year calls, 2 year calls. And he would do these trades. And it was just kind of, I realized one of the things that you avoid there is you avoid that data reaper. You avoid the kind of the decay that you get as you approach it. And a lot of times I'll go down and I'll like own a 1 year call. And then when it goes to 6 month, I'll roll it out back to a 1 year call. So my point is that when Trump hit and when he took power, I was like, this is it. This is the time to own volatility. And I still believe that very much so. I think that this is the perfect environment to own long dated calls and puts to express your views. And that is the better way to do it. Now,
what sort of deltas on those?
So I have another funny story about this. Yeah. So at one point I came up with this, like I wrote this piece and I had this very sophisticated strategy. I can't remember what it was, but it was a complicated ratio spread and it was like had a million moving parts and stuff like that. And then I went for dinner and I was with this fellow that I think he traded banks for Tudor or something. It was like he was, an old guy that had been around. And he says, yeah, when I'm bullish, I buy 30 delta 6 month calls. When I'm bearish, I buy 30 delta 6 month puts. And I'm like, oh God, that guy doesn't know anything. Like, guy's just whatever. And so I go home and I go into my model and I go and I like say, okay, well, I'm going to show him. I'm going to like take his stupid 30, delta 6 month puts, and I'm going to compare it to my strategy. And I went and did the model and I went and looked at it and I was like, oh, Jesus Christ, I'm making my life way too hard. This basically, it was almost the same thing. Like, it was like, yes, mine was slightly better, but for the amount of hassle, I realized he was just like, no, you know what? He's absolutely right. That's the way to do it. So in general, if, I do anywhere from 30 to 50 deltas, and I go from 6 months to a year. And that's how I look at it. Sometimes what I will do as well is that I will buy more out of the money ones. And the reason I do that, I'll layer it. Like I'll buy some 30s. And like, let's imagine I'm bearish on something. I might buy some 30 deltas. I might buy some 20 deltas, some 10 deltas, meaning that are progressively more out of the money. And the reason I do that is because if you are lucky enough to get into a situation where all of a sudden your option is in the money, you lose what's called the bend. So now all of a sudden your option's no longer trading as an option. It becomes more and more like one delta. And then all of a sudden you have to trade it slightly different. So I like to go and I sometimes will layer it a little bit. But the long and short of it is you were asking about how I manage with this new environment. And I think that the answer to that is in this new environment, it's never been better to owning volatility. And the one thing I think in terms of one of the trades I'm most excited about for the next year, it's foreign exchange volatility. I really think that we are about to experience some moves in foreign exchange like we've never seen before, or not never seen before, but haven't seen in many, many years. And that everyone is busy talking about stocks or even talking about bonds. The trouble about those two is that the implieds are already kind of pumped. We have a situation, well, stocks almost always trade fat, with a huge skew. Fixed income is definitely trading fat. The move, which is the VIX of the fixed income, it went up when the Fed started raising rates in 2022, and it's stayed elevated since then. So one of the things that I like is I think that the next part of this is that we're going to see foreign exchange vol bump meaningfully in the coming year as well. So if I have a view on currencies, I almost always express it with long dated options.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the number one institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure nodes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human-readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam-bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. That's really interesting. Yeah, I totally agree. I actually had another fellow Canadian, Brent Donnelly, on the show in January because I had a feeling that I was like, FX is going to be the asset class for this year, and it's proved correct. So yeah. Totally with you. Okay, I want to get into that discussion of FX full. I want to take one step back and look into the bond market and rates there, because I think there's some really interesting components there that you've also been writing about. So, okay, we've established this idea that high level macro, it seems bearish US assets. And then on the other side of things, it feels like capital's going back home. So we see capital going back home, and then just situation we've seen, Europe equities have been doing great. Rest of world bond yields have been surging as well, which is really interesting. So I want to focus in on the rate side of things there and how you're thinking about US bond yields and then also rest of world bond yields at this juncture.
Okay, let's talk a little bit about that element where that thing you said in terms of capital going home, because I think it's important and it really helps frame the whole narrative. And I'm going to bring this back to Canada if I could, because I think Canada is a good example. What is it? The longest undefended border in the world between Canada and the US? Our best friend, we've been there for a million different ways for America, and they've been there for us. And it's just kind of been a win-win situation. One day we get up and we're just like, hit in the face, like while we're sleeping. Like it's just like, boom, we wake up and it's like hit in the face. And we can talk about whether it was justified and whether Canada has been taking advantage of the US. And I have my opinions, but it doesn't really even matter, because like the reality is that the relationship between us was forever altered in a way that is going to take a long, long time to fix. It's all of a sudden, we as Canadians cannot rely on assuming that we're going to be able to sell our goods to America. There's just, maybe we will, maybe we won't. We're hoping we will. We're hoping we're going to be able to come up with deals, but it's no longer given. It's not something we can assume. So now all of a sudden we are faced with an existential crisis. Like we as Canadians woke up and said, hey, wait, this could really, really hurt our economy. And we sell, I don't know, what is some crazy number, 80% of the goods to America. And now all of a sudden we're worried about this. So we need to change our whole kind of infrastructure. We need to make pipelines to the coasts. We need to go and become more entrepreneurial. We need to lower taxes. We need to basically, compete on a global basis, right? And so for the first time, we are, how do you say this? It's like lit a fire under us because we have no choice, right? And one of the things that I argued when people would say, they're talking about the difference between the two parties that were running in our election, I said it doesn't matter who wins. The reality is that both parties need to, spend a fortune on changing our economy. So it really, truly doesn't matter. And this is happening the world over. Everyone is sitting there and saying, I can no longer rely on America being there to buy our goods. I can't assume that this huge bid for goods from America is going to continue forever. And all of a sudden, we are in a situation where instead of running a 2% deficit to GDP, we're like, we need to invest in ourselves. So that means we're going to go to a 4 or 5, maybe even higher. Maybe we go as high as the US. And one of the reasons that I became bullish on the rest of the world versus the US was because I looked at this and I said, US is running a 7, we're running a 2. Maybe the US this is back when I thought that they were actually going to cut, but the US is going to go from 7 to 3. We're going to go from 2 to 5. And so, pricing of securities is all at the margin. So that's going to cause us to outperform. And I think that is happening everywhere. And that is something that is occurring. And if we think about this in terms of if all of a sudden countries are spending more, like let's take Europe. Europe is long being criticized for not spending enough. And I have been very much in that camp that have kind of been critical of the Europeans for running too tight a deficit and for not spending enough. Now, all of a sudden, they're stuck with, well, we need to help Ukraine because America's not paying for Ukraine anymore. We also need to do infrastructure on our own thing. So what we see is when the Germany lifted their budget constraint, their self-imposed budget constraint, their stock market went flying. And if you ever wanted a proof about how important fiscal is, just look at that, right? Like the Europe was in the doldrums, stock market stunk forever. Germany said we're going to lift this constraint, and all of a sudden the stock market became the best performing stock market in the world, right? So you kind of have to think about this because what's happening is, whereas previously European pension plan managers couldn't invest in European equities, there was no return, there was no growth there. All of a sudden they're saying, oh, look, you know what? There's actually something happening here. We're finally getting the growth, the stimulus and things like that. And money is coming home. And one of the things that ultimately why I am really bearish on US versus the rest of the world is not only do we have this situation where the rest of the world is spending, but this is actually occurring at a point when the US is at the most over-owned period in history. Meaning, like, if you think about a kind of a global pension plan manager, they're all hugely overweight US assets, like in a monstrous way. And this has been occurring for years, decades. Money has been flowing into the States. So we're getting into a situation where it's overpriced, over-owned, and the US dollar is too expensive. And so all of this thing is coming home. Now, when you asked about fixed income, this is also creating an environment that's getting a little spicy because in the past, we had countries that had excess capital. Like we had Japan with all this extra money. We had Europe with all this extra money. Now, all of a sudden, these countries are actually spending. And so they're no longer sending it to the US. And then we also have at the same time, a government in the US is trying to, get the trade deficit down, which will mean less recycling of money. And so I'm actually quite concerned about the US fixed income market, the long end. And I am definitely not in the MMT camp that argues that the bond markets aren't anything you should worry about, and that there's no concerns there. Don't worry about it. It'll be fine. It's one of these things that there'll be buyers of the bonds. There will be buyers of the bonds, but it's always a relative game. If there's less money coming into the US, if there's more spending going on, if there's more kind of irresponsible not balancing of the budget, eventually what you're going to find is that you're going to have higher yields, and higher yields are going to mean lower stock prices, and it's going to be a real problem. And so you're asking about the bond market, and it's a complicated chess game, but for the first time in a while, I've been very concerned that the Americans are risking a Liz Truss moment. And I'm not going to say they're for sure going to have one, and I'm not going to say that it's not going to be fixable, but I do think that people underappreciate how much people are already long the bond market. Like if you go look at all the surveys, like go look at the JP Morgan duration survey, there's the record long amounts of institutional clients in long the bond market. You go look at the 30-year treasury or the 10-year treasury future, record longs in terms of asset managers. So everyone's already long, and yet prices keep going down. And I just worry that given that this pivot that you mentioned earlier, this Scott Bessent seems to have just abandoned like balancing the budget and has decided to outrun it by growing enough. And that's great. And it might be the right play, but that doesn't mean that the yield curve doesn't go super steep because he's running a hot economy. And that's what I'm increasingly worried about in the bond market in the US.
Yeah, I'm concerned too. And it feels like the line in the sand is 5% on the 30-year. Seems to be the, as Trump puts it, the yippee level. We've tested it a couple times now, and it's a really interesting moment. I agree, because obviously it's a losing trade to say that they're out of bullets for kicking the can down the road, but it sort of really does feel that way. And I'm curious, how do you think about the potential bullets that are loaded that they can use? Because you have the Yellen style tilting issuance to bills is still being run, despite Scott Bessent's criticisms of it. That's still happening. Treasury buybacks are happening. Powell is not really interested in doing anything. But yeah, how do you think about the potential bullets at hand to defend that if we got the trustification moment? Obviously, the Bank of England came in with temporary targeted QE, but yeah, what do you think would happen there? Do you think Powell would wake up finally, or what?
Well, so I'm kind of torn here, because I think it's funny that the moment the bonds get a little wobbly, people start talking about QE.
Yeah.
And I'm like, geez, I remember when term premium in the 10-year was 250 basis points. It's 50. Meaning that, for those who don't know, term premium is the amount extra demanded by the bond market for lending over a certain term versus their expectations of what the Fed funds or the short-term rate will be over that period of that life. And so one of the things that I struggle with is the fact that we've gotten ourselves so addicted to this QE that we think it has to come, we think they have to do something. And I'm not sure that it's not, I'm not even sure it's needed. I
agree.
I what's wrong with having a 10-year at 6? Mm-hmm. There's nothing wrong with that. That's not something that should be unheard of. And I really think that the yield curve should be steep. I think that makes it much better. You shouldn't be earning a lot of money by just owning something that's riskless. I'd almost rather see a situation where Fed funds is 2 and 10-year is 6, right? So if you're willing to go out the curve, then you'll get your 6, but you're taking a chance, and otherwise you're getting 2. So I know Warren Mosler talks about interest rates being, what does he call it? A subsidy for the rich, or what is it? He has some great line for it. And he's correct. You shouldn't earn a great return for not taking any risk. And so I have no problem with a very steep yield curve. And ultimately, I don't think Powell's going to do anything. I think Powell's just on hold, and it's nothing's good. He's not going to do anything plus or minus. He wants to stay out of the limelight. He doesn't want to do anything. I'm increasingly, though, of the opinion that the market is underestimating the chance that Trump fires Powell. And I know he said he wouldn't, but let's face it, he says a lot of things, right? Like, does that really mean anything? Like, are you going to really bet on, oh, Trump told me he wouldn't do it, so therefore I'm going to bet on? No. So I look at this and I say, they're in a really bad situation where they're having trouble with the deficit being too large. They don't want to cut, and they actually want the trade deficit to go down. One of the ways you could also do getting the trade deficit down is by having the dollar a lot lower, right? Like I think the dollar is one of the most overvalued currencies out there. I have a lot of American buddies that go around the world telling me how cheap everything is. And I go, no, it's not everyone else is so cheap. Yours is just really expensive. Like literally they'll say I can't believe it. I'm in Italy. It's so cheap. I can't believe it. I'm in Japan. It's so cheap. And they'll just talk about how cheap it is. And I go, no, you're in the most expensive country in the world. And if you want to fix this, if you want to be America to be able to compete on, manufacturing at any level, one of the things that's going to need to change is the value of the dollar. So I look at this and go, put aside the mayhem that will be created if he fires Powell. Okay. Cause it's going to be mayhem, but just stop and think, let's just imagine he was able to convince Powell to do something. Wouldn't putting Fed funds down to 2% and letting the yield curve get super steep accomplish exactly what Trump wants to accomplish? It would get the dollar down. It would make the trade deficit go down. It would make foreigners sell their U.S. assets because the dollar's going down. It would actually solve a lot of their problems. So when I look at this and I think to myself, okay, what is Trump going to do? I think that the market is underestimating the possibility that he fires Powell and just puts someone in there with it and puts it to 2%. And I know that'll be crazy. And I know that the yield curve will get super steep, but he's already look what's just happened now. He's told everyone that they were panicking for selling the stock market, right? He's gone and done his crazy thing. He's told everyone you're panicking, and now the stock market's rallied back up. Do you think that has encouraged or discouraged him from doing crazy stuff?
Yeah, definitely encouraged. I feel like the big issue at hand is that people are when you're referring to this idea of what would break with a 10-year at 6%, and it would be nothing other than, well, two things is that people I think are confusing this, that fixed income bonds are not reflexive. When you get to a certain bond yield, buyers step in. It's not like equities or whatever that can just go to zero. You get a high enough bond yield, that's where your buyers will show up. So there's that. And then there's also just it comes at the opportunity cost of other assets. And so I'm curious, how much are you a believer in this idea of basically, if you just look at earnings yield of SPY, S&P 500 versus the yield on a US 10-year, how much do you subscribe to this notion of, okay, 10-year at 6%, so US equities need to be down here with respect to it?
So that's the equity risk premium. So what you can think about it as the earnings yield versus the earnings, the treasury yield. And so if we just go back to March of 2020, I think the earnings yield on the S&P 500 was, I don't know, let's say 5.5 or something like that. And the 10-year was trading at 1. So it had an equity risk premium of 4.5. Fast forward to today, I haven't looked lately, but let's assume that the earnings yield is 4.5. The treasury yield is 4.5, or somewhere around there. The equity risk premium has gone down to 0. And you might say, okay, therefore, equities, in March of 2020, you should have been selling bonds hand over fist and buying equities. Yet what were most people doing? Most people were actually panicking about selling stocks and buying bonds because they figured the world was ending. Contrast that to lately, where you should actually be selling stocks and buying bonds in some ways. And I realize I'm talking about being bearish bonds, but having said that, on a relative basis, that is probably the trade to do here. Now, the trouble about the equity risk premium is that if you go and look at the equity risk premium and then you look at forward returns of the S&P 500, meaning you look at like the equity risk premium is here. So what does the S&P return over the next year? It looks like a shotgun blast. Like it's just a complete and utter, there is no relationship at all. But Ruffer, one of that great investment firms in London, had this terrific chart that I included in one of my pieces, and it was the equity risk premium versus 1 year forward returns. And as I said, it was just scatter point. And then they did equity risk premium versus 10-year S&P forward returns. And all of a sudden it became this beautiful, tight correlation, meaning that the equity risk premium, or like this relationship between stocks and bonds, doesn't help you for determining the returns of the stock market over the next year. Okay. It doesn't mean anything. However, it means everything over 10 years. 5 or 10 years. And you'll often hear Mike Wilson from Morgan Stanley. He'll talk about this all the time. Like I love watching the guy. I love, listening to what he says. And he'll say, I have no idea what stocks are going to do over the 6 months or 1 year, but I'm really confident. And I can tell you within a 95% that it's going to do this over the next 5 or 10 years. So when your question is, how much do I pay attention of that relationship? I pay a lot of attention. I'm just very careful to make sure that I use the correct time frame when I'm thinking about that relationship.
Nice. I feel like most lessons in trading is just having the right time horizon for something.
Yeah, so you're absolutely right.
That's so true. Okay, so to wrap up here, in terms of where this all nets us out, I was in this perplexing situation as you were, where it's like, okay, the trade of rest of the world and then bearish US made a lot of sense when fiscal deficits were going to go from 2 to 5 in the rest of the world, while the US was going to go from 7 to, I don't know, maybe 3, like Besson wanted.
Yep.
But now we're in the situation where, okay, US fiscal deficits are actually going to go from 7 till, if this bill passes, 8. Yeah. And then in the same time, the rest of the world is also going to go up. So it's like, okay, well, am I just bullish everything? But then you bring in these notions of what you're saying in terms of positioning within the US is way overweight there. There's the bearish dollar framework that would be attributed to within all of this too. So yeah, I'm curious, how do you net out your overall positioning? Is it still that rest of the world bullish, bearish US?
So I'm still in that camp. And ultimately, the one thing that we haven't talked a lot about is the private sector part of the equation. And this is, again, something that I differ a little from my MMT folks, friends on, is that I still attribute there being some value to that. And so when we go back, rewind to, November when Trump took over, part of the narrative of why this U.S. stock market was going to do so well was that we were going to get this massive deregulation, and it was going to bring about all this private sector credit creation. It was like the banks were going to be able to lend, and we were just going to be off to the races. And I accepted that. I thought that the banks were a great purchase, because that if we do get deregulation, they will be able to lend. That will be positive for the economy. I thought it was going to be more than offset by them trying to rein in the budget deficit. But now we're in this situation where it's the budget deficit is kind of taken over. And yet now, when we think about the private sector credit creation portion of this, I would argue that the volatility, the erraticness of his policies has basically killed that aspect of private sector credit creation for a long time. And I just go back and think about, like, if you're sitting there and you're a foreign competitor, or not even a foreign one, even if you're an American one, you're Intel, and you agreed with the previous administration to build a plant in the US to, make chips. You were promised X, hundreds of millions of dollars. Well, Lutnick went and said, well, you know what? If you don't do more, we're going to withhold that. Like, they actually held them hostage. Like, he literally said that. He said, if, people that are expecting money, if you don't end up doing more, we're going to not give you the stuff that was originally promised. And I just think about that. And I'm like, is that really like the way to go and encourage more private sector credit creation? Like how can you be, as a CEO, excited about investing in that environment? Like, here's another one. I'm just going to read this Donald Trump tweet. Walmart should stop trying to blame tariffs as the reason for raising prices throughout the chain. Walmart made billions of dollars last year, far more than expected. Between Walmart and China, as they say, eat the tariffs and not charge value customers anything. I'll be watching. And so will your customers. Like, can you imagine if Biden or Obama had done that? Like this is supposed to be a business friendly administration. And he is telling them, no, you shouldn't, raise prices on this. So although I understand why we're going up and why we're getting this liquidity fueled deficit kind of induced rally in the stock market, at the end of the day, I actually think that the private sector portion of the equation is considerably worse, and that if it is becoming more and more difficult for long-term decisions to be made. And therefore, I think that, put aside the day-to-day fluctuations about the stock market and, chasing things and all the different idiosyncratic portions of it. And just think about if you're sitting there in your Walmart, or if you're Intel, or if you're any company, and think about whether this is the kind of environment you have the confidence to invest in. And it seems pretty clear to me that it's not. And that ultimately that's going to harm U.S. business.
So this is interesting, because I know you wrote recently about being short corporate credit, and I was trying to compare that with your idea of, okay, fiscal deficits are going higher, but it's a bet on this specifically.
Yeah, and ultimately I'm short corporate credit over the short little while, because I think that the stock market is going to be bid more than people expect because of the vol control strategies. So there's this weird phenomenon where like a lot of these pension funds and endowments run money based upon these vol control strategies that are often backward looking in their volatility, inputs. So we get this situation where on the decline, they all sold into they sold as it was going down because volatility expanded. And then the fact that we've rallied so hard has caused realized volatility to stay elevated. And so they have still not bought back into the market. And as things slow down in terms of the market becomes less volatile, those really crazy volatile days of the past 30 days will roll off, meaning that realized volatility will go down. And these vol control strategies will therefore be forced to buy back the market. And unfortunately, these sorts of strategies mean more and more. So when I'm thinking about the next month or two, I'm thinking the vol control bid is going to be there below the market and just kind of incessantly buying stock. And then on the credit portion of it, we had this situation where we had all of this money get refinanced in 2020 because there was this huge bid to issue into because of the COVID QE and stuff like that. And a lot of those companies that are the worst credits can only borrow for 5 years. That's the general, high yield term. So now all of a sudden there's this kind of huge refinancing wave that's occurring. And over the past month or two, with all the volatility in Trump's policies, a lot of those corporations have actually put it on hold. And so therefore they haven't issued as many bonds as they would have liked to. And now as things settle down, as the market rallies and we get into an environment that becomes more normal, they will be issuing a lot more corporate credit. So for that was kind of just a real kind of inside baseball trade where I thought corporate credit will underperform stocks. They usually go together very, very neatly, but I think that corporate credit will be worse because of increased supply, and bond and stocks at the margin will be better bid because of the vol bid. Now, having said that, on a longer term picture, this is kind of one of my longer term trades. I think that the corporate credit indexes are actually better than they were in the past. And I don't think they're going to get as, when we finally do get a corporate kind of cycle, meaning that we get some defaults, they're not going to be as bad as in the past, because I think a lot of the really junky stuff went into private credit.
Yes. Yeah.
And so I really think that that's where the next disaster is going to be, is in private credit. And so one of my favorite trades is to be short the private equity and private credit companies that are out there listed on the exchange. I can't go and actually short the things that they own, but I can short them. And I think that they're going to be a disaster in the makings. And by the way, yesterday I saw JB Diamond, the CEO of JP Morgan, who knows a few things about credit, talking about how he thinks that this is going to be a terrible environment. And he said, I think his exact words, I wouldn't be a buyer of credit here. Mm-hmm. Well, I wouldn't be a buyer. I'm actually a seller. So yeah.
Kevin, that hour flew by, but man, I really love that conversation. I appreciate it a lot. Covered some good bases there.
Hey, before we go, so we were talking a little bit about skiing, and I was looking through your LinkedIn, and you were Whistler ski patroller?
I did some ski patrolling.
Okay. So first of all, that mountain hates me. It rains top to bottom every single time I'm there. Okay. But when I go back next, I want your favorite shoot and then your favorite bowl.
Oh, okay. I can't say these publicly because they're important powder stashes, but I will email you them.
Oh, that's hilarious. Okay. Hit Felix up privately if you want to know where you should go. Anyways, thank you very much for having me on. And for anyone who wants to get my stuff, just send me an email, kevin@themacrotourist.com, and I'll be happy to send you some samples.
Amazing. Yeah, appreciate that a lot. Yeah, definitely go check it out. Well worth it. And you do some good work. Appreciate it.
Thanks. Nice meeting you, and thanks for your time.